Welcome to Common Sense Society's discussion on Chinese investment in Europe. I'm Liza Tobin, Senior Director for Economy at the Special Competitive Studies Project. I'm also CSS faculty member for the John Quincy Adams Fellowship. We want to welcome all of you to this discussion, especially if you are new to CSS. CSS is an international education network dedicated to strengthening citizen competency by promoting liberty, prosperity, and beauty. These three timeless principles change lives everywhere and constitute the political, intellectual, and cultural inheritance which constitute our shared civilization. In recent months, CSS has hosted briefings on the ongoing crisis in Israel, events in France and England, and today we will take a look at the risk of the PRC's ongoing investment in Europe. Some key questions we'll grapple with today include: what security and economic risks are European countries really taking on? What are the consequences? Is the Chinese Communist Party already at the helm of European influence? And with all of the geopolitical changes underway in Europe, China, and around the world, what does the future hold? To address these questions for us today, I welcome two excellent experts. First, Dr. Magdolna Sass is the director of the Institute of World Economics, Center for Economic and Regional Studies, and assistant professor at Budapest Business School. She instructs on global value chains, trade and foreign direct investment flows, multinational companies, and Hungary's foreign economic policy. She is also a senior researcher at the ICEG European Center and previously served as a senior research fellow at the Institute of Economics, Hungarian Academy of Science. I also would like to introduce Dr. Misha Auslin. He is the Payson J. Treat Distinguished Research Fellow in Contemporary Asia at the Hoover Institution. He is also a senior fellow at the Foreign Policy Research Institute and a senior fellow at London's Policy Exchange. Formerly, he was associate professor at Yale University, among with a number of other distinguished positions. He is the author of 6 books, including his most recent one, Asia's New Geopolitics: Essays on Reshaping the Indo-Pacific. I would also put in a personal recommendation for his excellent podcast, Pacific Century, in which he brings in a number of wonderful experts, from policymakers and scholars to practitioners, to discuss in-depth issues in Asian geopolitics. Thank you both very much for joining us. So I'm going to give each speaker the opportunity to spend a few minutes kind of giving an overview of their perspective on this issue of Chinese investment in Europe, and share a little bit of their expertise. And then after that, we will move to some questions and answers. So if it's all right, I would like to turn to Magdolna first to give some brief opening remarks.
Thank you very much. First of all, I would like to thank you for the invitation and for being able to participate in this very interesting meeting. I think that's a very important question we have to really talk about. I have prepared a few slides just to illustrate what we talk about and how we have problems in assessing actually what we talk about. So next slide, please. If we have a look at the balance of payments data, then we cannot really see very big inflows of and stock of Chinese FDI in selected European countries. The basis of the selection is that for these countries, for this group of countries, there are better data available, which show us actually much more about the extent of Chinese FDI in these countries. So this is what we knew before 2013 in terms of FDI from China in the countries in question. But if we go to the next slide, we will see that we have new data which are giving us a much better estimation about the stock of Chinese FDI in these countries. And what you can see is that basically in all countries, the actual stock, which is based on the ultimate Chinese ownership of these projects, is much larger than we thought before we had these new data available from these countries in question. The problem is that it is just a handful of countries, as you can see, who present these new type of data, which refer to the ultimate owner of the various foreign direct investment projects in these countries, while the previous data referred to the direct owners, so from where the money comes from directly in the countries in question. So what we can see from this slide is that in everywhere we have a much larger amount of Chinese FDI stock based on ultimate Chinese ownership than we previously thought when these data were not available. If we go to the next slide, we can see here that actually these are quite substantial, these new based on the new data. So in some countries, the stock of Chinese FDI exceeds even 1 billion, 10 billion US dollars. So this is something really substantial. If we go to the next slide, we will see that indeed it's by now quite substantial, and there has been a very quick growth in the last 8 years in terms of Chinese foreign direct investments in Europe. So basically in the 6 countries for which we have the data available for 2013 and 2021, there is a very big increase in Chinese investments. Next, the next slide makes us a little bit kind of normalized picture based on per capita Chinese foreign direct investment stock in the analyzed countries. And you can see that it's quite high in the developed part of Europe, in the western part of Europe, and Hungary stands out from the less developed countries of Europe in terms of per capita, ultimately Chinese-owned foreign direct investments. The next slide will show us that still, in spite of this very quick growth and in certain countries quite substantial stock of Chinese FDI, in terms of the share in total FDI stock, still China is not very important. So we can see that Hungary stands out with an almost 3.5% share in the total FDI stock of Chinese FDI, but in all other countries, this remains quite substantially below 1.5%. The next slide will show and will supplement this picture with showing the top 3 investing countries in 6 economies. And you can see that China could make to be the 10th largest investor in Italy and Hungary, but in all the other countries, its rank is much lower. So basically, we can see that China is not among the top investors in the European countries still, in spite of the quick growth and in spite of the quite substantial FDI stock in these countries. And I also added, if we go to the next slide, a few important kind of illustrations which were prepared based on Eurostat data, and I borrowed one chart from The Economist. One thing which should be taken into account, the relatively high reliance of the European Union on China in terms of its foreign trade and mainly in terms of its imports. So what we can see, there is an asymmetric relationship evolving between the European Union and China in foreign trade, whereby we can see that the European Union reliance on China is becoming more and more strong, while Chinese reliance on European imports from Europe is much less important. Another important thing I just wanted to mention is we can call it also industrial policy, which is very much present in China recently, and which has actually manifested in a very quick increase in spending on research and development in China. You can see the comparison between the US, European Union and China, and in that respect, the European Union is lagging behind considerably. Later on, when we will talk about the Chinese investments in Europe, we can mention the importance of this. And one more slide I just wanted to show is an interesting, and we may elaborate on that later as well, that we have an increased kind of competition for FDI in the world economy. As you can see, the UNCTAD each year presents the data on the changes in national FDI policies. And here we can see that there is a kind of increased competition for FDI. More and more countries introduce measures which are favorable for FDI. So on one hand, we see that tendency. On the other hand, we see an increased number of monitoring, which is mainly targeting Chinese FDI, and not only in Europe, but also in other countries. So on the other hand, we can see a kind of screening, monitoring tools which are now proliferating in the world economy. And I would like to stop here. I just wanted to raise a few and highlight a few tendencies which I think may be interesting later on to talk about. Thank you.
Thank you so much, Magdolna. That was a really great place to start with some actual facts and data. And a lot of things come through to me. I'll return to some of them in the question, but really it's clear that you can't paint with a broad brush and sort of characterize Chinese FDI into Europe as being kind of similar. It varies quite dramatically across regions and between countries. And the trends are clearly shifting a lot in the last few years. Next, I will turn to Misha and welcome you to make some opening remarks. Over to you, Misha.
Well, thank you, Liza, and thank you to the Common Sense Society, not only for this program, but for all the work that they do, which I think is increasingly critical. So I'm very happy to be here today, not as a Europe-China investment expert. That's Dr. Sass, and I think she did an extraordinary laydown of how China's investing and looking at it. So I can speak a little bit, I think, mostly raise questions, but speak a little bit to the perspective from Washington, D.C., which is where I sit. And to start off with just a few commonplace ideas. The first is that for the U.S., this question of China's global investment is now becoming a policy issue. Meaning, I think up until, really up until about 5-6 years ago, when the general policy perspective on U.S.-China relations and China's role in the world began to change, there was a very open and accepting view of Chinese investment, not only in the United States, but around the world. Everyone thought that this was, in fact, exactly what we wanted, of course, which was to get China more involved in the global economy, make sure that it had a stake in open trade regimes and fair trade regimes. Obviously, bringing it into the WTO was probably in 2001 was probably the crowning point of that. So my point is simply that I think until very recently, Washington has not looked with a particularly critical eye at Chinese investment, whether here in the United States or in Europe. But over the past 5 years, as our overall policy perspective has changed, we've begun to see much more clearly the links between what China is doing, or to put it just in a neutral way, how China's investing in the United States and how it's investing in partners around the world, in this case, as we're talking about today, but also in Asia and other areas. Probably the one area that did get attention, at least a little bit, was Africa, because of the sort of unique and dramatic way in which China invested, the environmental issues, some of the social issues, a lot of the negative impact that it had on African countries. But for the most part, in the developed areas, there was much less concern that we should look at how all of this is interlinked. And I think that some of the data, in fact, that Dr. Sass showed us is something that it is a starting point, and that we need to, in fact, go beyond, which is to look at the specific sectors and areas in which China is investing. We're starting, of course, to do that in the United States. We need to do it with allies and partners. Are these areas that are either critical to the Chinese economy? Are they critical to the European economies? What is the level of, I guess a better way to put it is, what are the specific types of externalities that come from these investments in terms of transfer of intellectual property, for example, or the ways in which, as we've seen here and other countries have seen, China getting into a domestic sector over some period of time, beginning to dominate it, and then in essence, foreclosing opportunities for domestic producers within that sector. You can raise things like solar in the United States is one. Electric vehicles is still a contested area, but one where China has made great leaps. So it's not just the gross measures of investment, it's where and how the investment is done. And I think that then leads us to the question of how this fits into the broader national security, national power concerns of Beijing and of the party. What exactly are the goals? Now, it's obviously far too crude to say that China doesn't care at all about the economic issues, that it's simply concerned about getting influence in countries, getting a toehold into countries. Of course, it cares about the economics, it cares about the returns, it cares about the knowledge that it gains, the technology that it gains. It is not simply a Trojan horse, so to speak, to get it into European countries. That acknowledged, however, that said, it is clear, I would argue, that from the Chinese perspective, all of these investments are part of a broader strategy, a broader national security and domestic security strategy, in order to strengthen the country, which means strengthening the state and ultimately strengthening the party. So again, the areas specifically where they are investing, I think, is crucial to look at. But then how and if the relationships between China and the target investment countries have changed as investment has grown over the past several decades. Clearly, we saw in the case of Greece, when Greece was chairing the EU and chairing meetings of the EU, that it worked to water down resolutions that were critical of China, critical of Chinese policies. Of course, we saw that during COVID as well, countries that received a great deal of aid, that's different from investment, of course, but great deal of aid. There were political knock-on effects. And so I think we're just at the beginning of trying to understand both the gross measures of investment and how that has, from our view, investment is to benefit both sides. Has it benefited both sides? Where has it not benefited both sides? But more granularly, where and how and when and why is China investing in European nations? Has that had a political effect in any way? And from a purely parochial American perspective, how has that, if at all, affected the partnership or even alliance relationships between the United States and European countries because of goals that China has, that we've seen played out in Asia and other places? So again, maybe more questions than answers, but working off of the excellent presentation that Dr. Sass gave, just starting off a conversation. Thank you.
Thank you, Misha. I think it's tremendous that the two of you have really complementary expertise, and you've really done a lot to kind of fill out the broader geopolitical and, from a China perspective, what China is trying to get out of this. We will now go to some questions, and I will direct some of my questions to either Misha or Magdolna based on the work they've done previously, but I would very much welcome if either of you wants to weigh in on each other's questions. Just indicate that by jumping in or using the hand raise function. So I'll go first to Magdolna. Magdolna, you've done a lot of research and you've shown us kind of the tip of the iceberg of your research on PRC FDI into Europe and Central and Eastern Europe in particular. And in some of your written work, you've concluded that there are more risks associated with Chinese FDI compared with FDI coming from other countries. So I'm just wondering if you can expand on that a little bit. What are those risks? You've been writing about this for a number of years, and so I would also love to hear how these risks have evolved in recent years, including commenting on how Europe's understanding of these risks. Are European nations more sophisticated in their understanding of these risks? And regarding Misha's comment in his opening about the importance of considering specific sectors and how sectors vary and some of them are more strategic than others, are there any specific sectors you would like to highlight in terms of growing risks? Over to you, Magdolna.
Yes, thank you. I think that's a very important question, and I just wanted to say that I'm rather an FDI kind of person. So I deal with Chinese FDI, but not really with the Chinese economy. But still, I found it very interesting and exciting how when Chinese FDI started to come to Hungary and how it affects differently the Hungarian economy compared to other investments. And that is how I came to the conclusion that this type of, Chinese FDI brings, can be considered more risky compared to, let's call it traditional FDI coming from Western Europe or from the US. And I found the reason in that it does not really operate based on kind of profit principles, based on market economy principles, but it has other motivations as well, and that makes it quite risky for the host economy. I found an interesting paper which was written already in 2004, and it said that there are 4 aims of Chinese outward FDI which should be fulfilled, and these are not only economic aims, but there are, for example, other aims such as access to new technologies, access to raw materials, access to hard currencies, and the increase of Chinese exports to the countries which host these FDIs. So it seems that there are not only economic reasons, but also other reasons which somehow shape Chinese FDI in other countries. And we can see a few cases, and that's how, and I completely agree that it really matters where this FDI is invested. We can find on one hand the technology kind of acquisitions in Europe, which happened in earlier years. And even now we can find some cases when high technology firms are acquired by Chinese investors. Partly, I think that was the reason why during the 2008 and 2009 crisis, it was the experience of some big European nations that Chinese FDI actually took advantage of being able to buy very cheaply high-tech firms in the European Union, and that actually induced the European Commission and the European Union economies as well to try to introduce measures before the COVID crisis started. Actually, in 2019, they already started to monitor the inflow of Chinese projects. Another case which I would like to mention is which does not completely fulfill a kind of market economy based behavior principles is the case of the rare earth metals, which are basically monopolized by the Chinese investors at home and abroad, and through increasing the extraction of these rare earth metals, which are very much needed for digital kind of products, for electronics products, for many other things. They increase the extraction in China. They also grab foreign mines which have these rare earth metals, and they basically do not give access to other companies to these rare earth metals. They increase the prices of these on the world market as well. So that's another kind of market-based, I would call, behavior when you do not go for the profit, you do not go for the price, but you have other motivations behind. And that's why I think the behavior is much less kind of calculable of Chinese investors than in the case of a German or a US investor in Hungary. Other cases I just wanted to mention very briefly from our region is that in Hungary, we cannot really find big scandals with Chinese investments, but that's not the case in Czechia and Poland. We have very strange cases in Poland. The COVEC, the China Overseas Engineering Group, was won in a public tender with assumptions which were completely not in line with how the Polish economy is actually operating, and at the end they had to resign from building a motorway. The same happened in Czechia with the CEFC company, which was very intransparent in terms of its ownership, in terms of its financing. It basically made a kind of shopping spree in Czechia. It bought not only production facilities, but also hotels, football clubs, and everything. And at the end, the arrest of the CEO in China led to closing down all these units in Czechia. So you can see that this non-market-like behavior kind of traces can be seen, which I think brings quite a high risk to the countries where they invest. I would stop, I think, here, and later I would.
Thank you so much for that. I want to remind the audience that if you have questions for our speakers, you can put them in the chat. We will try to take a few minutes at the end to give them an opportunity to address some of your questions. I also thank you for that answer, Magdolna. I want to take moderator's prerogative and ask a very brief follow-up question, tying back to something that you've highlighted, the indirectness of Chinese ownership, and you had a slide showing how when you actually look at the data for the ultimate beneficial owner for some of these FDI transactions, it goes back to China and how that kind of increases the amount of FDI that's actually going in there. So just the importance of having good data and what that data can reveal, how our intuition isn't always correct. So I just wanted to give you the opportunity to explain this comment of indirectness in your research, and what are the implications for Europe, and do you think that's well understood? Thanks.
Thank you. Just very briefly, this is something very interesting, I think, and now we have data, at least for some countries. There was a question why the UK is not included. The reason is simple, that I took the data from the OECD, and for some reason, I know the UK has the data, but they don't submit it to the OECD statistics. So that's why I concentrated on just a few countries. So now we can see that Chinese FDI tends to come rather indirectly through other countries to the final kind of host country. But this is not a Chinese specificity. This is very much characteristic for US investments in Central and Eastern Europe, for example. They come through the Netherlands, through Luxembourg, through other countries. Also for India, India is basically present just indirectly in the region, a little bit for Japan and not for Korea. So here I can see rather kind of specific kind of business culture impact, but also in these cases, the reason is in many cases tax optimization or tax reduction. I don't think this is really relevant for China. In the case of Chinese investments, it can be rather that on one hand, they want to conceal the real origin of the investment in many cases. In other cases, there is a simple organizational reason. They usually have a kind of regional or continental center which oversees all investments in the region or on the continent. And the third reason can be, and that's very interesting, and this is actually highlighting how more and more important Chinese investments are becoming in Europe, that in the case of Hungary, we found cases when the indirectness is related to the fact that the Chinese multinational company has acquired a European company which has subsidiaries in other countries, including Hungary. That is why it is indirect, because it acquired the parent company and it became the owner of the parent's subsidiaries, which are spread in Europe. So this is also one reason, and this is increasing, and I think it will increase in the future. Thank you.
Thank you. Yeah, and I think your research illuminates how difficult it can sometimes be to identify PRC ultimate beneficial ownership, which in turn poses a challenge for policymakers. I can speak from personal experience that sometimes when we identify problematic firms and list them on entity lists and such, sometimes that doesn't account for things like subsidiaries, which are under other names and going through different countries. So thank you for illuminating that. Turning to Misha, you've already touched on this a little bit, but I wonder if you can say anything more. Just help the audience understand, could you characterize the CCP's global ambitions And how does Europe, including investments and economic ties, fit into China's global strategy for achieving its ambitions? And since you did touch on that a bit in your opening remarks, just to take it a bit further, do you hear things that are missing or wrong from our understanding of these issues? What is the media and kind of the hot takes on this issue missing in terms of accurately conceptualizing how China approaches Europe as part of its grand strategy? And also, if you care to comment a bit more on the issue that you raised about U.S. transatlantic partnership and how China's approach to Europe has affected either negatively or positively the partnership and alliance between the U.S. and Europe. Sorry, I know that was a lot.
That's a lot.
Please feel free to start wherever you like with that.
It's a lot, and they're hard questions, especially the first one. So I'll actually start with the last. Sorry, I will actually start with the last question on the transatlantic relationship to say that there's a lot of action, I would say now, and I think now there's a difference, of course, between concrete achievements, first of all, setting concrete goals and then achieving them, and whether, of course, those goals are exactly what's needed to protect interests and in our case, deter deleterious actions or policies on the part of China against us. But compared again to 5 and certainly 10 years ago, there is a great deal of discussion, a great deal of, I would say, the beginnings of coordination, the recognition that this is not merely a benign relationship, and therefore we have to face it together. Now, there's two parts to that, actually, I would argue. For the U.S., primarily, we have been interested, if you take away, of course, the idea of just protecting our assets and interests at home, it is our forward-based, allied-oriented presence in Asia that's been our primary concern in terms of dealing with China, right? The seas of Asia, whether it's the East China Sea or the South China Sea, obviously the Pacific Ocean, increasingly the Indian Ocean. And of course, we have a whole series of treaty partners, alliance partners, formal alliances, 5 of them, and a whole host of partners. So we've looked at how do you blunt Chinese interests? How do we protect the interests of partners, U.S. interests in the region? And for most of the post-war, post-World War II history and even post-Cold War history, Europe was not a major factor in U.S. thinking. When it was mostly the very few European countries that had a presence directly in Asia, France and the UK being the best examples, though of course trading nations like Germany had a great deal of interest there, but less of a direct presence. So in terms of Central Europe, Eastern Europe, there was much less of a discussion because they simply were not present in Asia in the way that we were and our allies were. That's different from the way we now look at China externally. We used to think of it mostly within those geographical confines. And of course, this whole discussion today is about FDI into Europe from China. So we've now expanded the geographical frame of reference to look at Chinese actions around the globe, but in particular, in case of what we're talking about, Europe, and therefore having much more discussions with our European partners. Again, I would say that has largely been with the major allies, the sort of long-standing traditional allies, the British, the French, to some degree, the Germans, of course, the EU, which is always a little bit harder for Americans to understand the difference between EU foreign policy and trade policy and individual countries doing their policies. But all of that has come much more to the fore because we do see the question of intellectual property rights. We see the question of elite capture. There was a question online about the WHO. That's what we might call an example of elite capture. In an international organization, there's elite capture within countries themselves, and we all face that. So that is the type of discussions I think that we're having. There's not yet, a common policy. There's not yet a common strategy, but there is, I would argue, the beginnings much more of at least having regular conversations. And then I would hope that we'd be starting to get, as we build things, for example, like the AUKUS agreement, which is with the UK, so directly looking at the UK's interests in Asia along with ours, US and Australia, we might then think about bringing in other European nations. So it's the beginning, but you know what? It's the beginning for all of us reassessing China relations. 10 years ago, we probably wouldn't even have had this conversation because everybody thought Chinese investment was an unalloyed good. And now we recognize that it's not. And Liza, your point about subsidiary and shell companies is very important. We put certain companies on watch lists, we put restrictions on them, and then we find, as we just did with the semiconductor related company Bright this past week or so, that their second largest shareholder is SMIC, and so it's directly related to Chinese chip production. They're getting US software. They're evading, in essence, some of the restrictions we put. So we're having to get smarter about all of this, only because we didn't think we needed to be beforehand. Part of that, I think, goes to your first question, which is, Chinese overall grand strategy. It's a very hard question. There's lots of different elements. It's both banal and yet, I think, accurate to say that what China seeks is a world safe for Chinese interests, for Chinese investment, for Chinese political activities, to shape particularly the nations around it, their sets of relations with China in ways that do not challenge either Chinese territorial claims, Chinese infringement on intellectual property rights, Chinese domination of international fora, both those in Asia and those outside of Asia. And that is something that then spreads to Europe, to the US, to other regions. You can look at elements of this strategy, such as the One Belt, One Road initiative, as ways of linking not just Central Asia into an infrastructure and investment-based Chinese set of priorities, but all the way to Europe, where it has spread. And as part of Dr. Sass's presentation, showed the level of direct investment in European countries, some directly related to One Belt, One Road, some just independent. What is it ultimately for? I mean, I'm not, I don't think it's shocking. I'm part of the realist school that countries simply seek to maximize power. They maximize their position on the global stage, but it becomes a question of scale. It's one thing for Hungary to attempt to do that and do it by its own sets of interests, and rightfully it should do that, in congruence with international norms and interests of partners. It's a very different thing when China does it. Now, you look back at 1980, there was no real concern about China importing wholesale factories from the US and all sorts of intellectual property that would allow it to begin modernizing and emerging from the post-Mao economic, social, and political chaos that it had undergone since basically the 1950s. That's a very different prospect from looking at a China of 2010 or 2020 and the massive influence and impact that it can have. You can refer back to the David Autor paper on the China shock, that sort of seminal paper that upended a lot of the neoliberal thinking about what does it mean for a country like China to enter into the global economy at scale, and the type of destabilizing effect that it has, meaning global economies, regional market systems are not able to adequately reach equilibrium when there is this massive influx of China. And so you see great disequilibrium, great inefficiencies introduced that take, in some cases, decades, if we ever have tried to solve them. The loss of domestic productive capability, basically the dominance of domestic markets. I think I certainly am, and I would argue many of us are much less familiar or skilled, even if I can use that word, in understanding the financial elements of this. A little bit easier when you look at, okay, they've come in and taken over a productive sector, and now everything you buy is from China. A little bit different when you're looking at the sort of invisible elements of finance and how finance changes. And I think our European partners will probably face it sooner than we do, the move that China has been making over the past several years to move away from dollar-denominated exchange, to have settlements in the renminbi, to work with Russia on that, where there was just another recent agreement to get other countries to buy into moving away from the dollar, how that's going to affect us. And of course, it's easier to put pressure on smaller countries, partners of the US throughout Europe, for example, than it is to do that to the US. And so, again, I mean, I don't pretend to be an economist or an investor. I can only look at it as best as I can from the political side, and to say that simply we did not ask these political questions because we didn't think they were political questions. So for 40 years, we did not look at risk. We looked at opportunity. And of course, there was opportunity. There was an enormous amount of opportunity, but there was always risk associated with that. And we for a number of reasons, chose not to look at risk. What we are doing now is playing probably the greatest game of geopolitical catch-up in history to try to understand risks that we ignored. Some of that was brought home through COVID, risks of supply chains, different vulnerabilities. Some of it was becoming better known in the mid to late 2010s through reports like FireEye and Mandiant's reports on the pervasive degree of IPR theft on the part of China, and of course the U.S. IPR Commission that estimated that $600 billion a year in IP was stolen from the United States, a great deal of that from China. All of these things we are finally catching up on. Politically, it's manifested itself in what people call a new Cold War. Is it Cold War II? There are reasons, I think, to look at it in that lens and reasons not to look at it that lens. I think it's simply a question now of a new realism. And quite frankly, and what I think what the Trump administration was trying to do and what the Biden administration has done in certain ways is to make, or at least to explore, elevating the principle of reciprocity to a central part of this relationship. I don't know the degree to which our European friends have tried to do that. For the US, again, our scale makes it easier to address the Chinese scale. But this question of reciprocity, of access, which is the same thing in investment as it is in, let's say, student access or journalistic access. So we are beginning to tackle all these things, and we're beginning to do that, to go back, to end here and to go back to your open first question, Liza, because of what we are now better understanding about China's grand strategy, which, if you listen to what Xi Jinping says, if you read the documents, they see themselves in a competition, in a struggle with the US. It is certainly, I would argue, not of our making, but that's in a sense irrelevant. It is reacting to the reality of the way that China acts in the world through investment in FDI in Europe, as it does on the Asian seas.
Thank you so much, Misha. And you've actually done a great job of pivoting me to my next question for Magdolna primarily, but if you want to weigh in as well, please feel free, Misha. And that's on, what's been in the news about China recently is the health of the Chinese economy and the slowdown, real estate crises, the fact that their population is now shrinking, consumer demand is not high enough, all of these economic problems, FDI actually leaving China at a faster pace than it's entering. So, Magdolna, what's your take on all of this negative economic news coming out of China and how this is affecting how this is affecting their FDI into Europe and the implications of all these changes?
Thank you for the question. I think it's from the present economic problems of China are maybe making the Central Eastern European countries, or even Hungary, which are kind of gateways to the European markets, even more attractive to the quite large and affluent European market. what we can see that in Hungary, we have a big increase in Chinese FDI recently. We have large investment. Actually, we have the largest in history up till now investment by a Chinese firm announced in India battery production. And also some infrastructural investments in Hungary. It seems to be that Hungary has taken up this role of providing a kind of location for China for export platform type of foreign direct investments, which are then targeting the whole European market. And so we couldn't see any kind of subsiding in FDI from China. What is the problem that all these investments, or almost all of these investments, are coming in the electronics battery industry, which seems to be very important now, and we see some kind of historic patterns repeating themselves. We had the solar panels, we have now the electronics batteries, and then now we have, it seems, the e-vehicles as well, in which we see the same pattern, that Chinese producers and exporters are lowering the prices to an extent in which they are the local players are actually expelled from the market, or they exit the market because they cannot compete, a kind of dumping. And the interesting thing is that the technology is then coming, as it was already mentioned, from the US somehow, which is then further advanced and further developed by the Chinese companies, which are acquiring them. And it seems that based on that, they are following a kind of strategy in which they basically expel other players from the market. This is especially important for Europe, as the European economy's most important kind of locomotive can be the automotive industry on one hand, on the other hand, the German economy. And in these sectors, it can hit really hard the German economy and the European automotive industry if the Chinese companies will be acquiring the market. We see very, very high increase in exports. We see increase in foreign direct investments in these certain sectors in Europe coming from China. Thanks.
Thank you so much. And I know that also addressed some of the audience questions in the chat about the implications for Europe of China's expansion of EV exports. And that certainly is going to be a very hot topic in the US and in Europe, how both of our countries or sets of countries are going to respond to this coming flood of Chinese EVs that we're going to have to deal with trade measures or otherwise. Thank you for that. Turning back to Misha, you have spent many years studying Asia writ large, and I would contend that some of our Asian democratic allies have lessons to offer for Europe about how do you live alongside a major autocratic nation that commands the second largest economy in the world and a very powerful military. So I'm just wondering, based on your experience studying Japan, Taiwan, and other Asian democracies, is there maybe one or two lessons that you think their experience dealing with China has to offer Europe?
You know, it's an interesting question, Liza, and I may answer differently than you thought I would, which is say I'm not sure how well that the neighbors have learned lessons, simply because living next to China has made it, there is no buffer. You know, there is a buffer zone for the US, for Europe, Latin America, which most of us chose to ignore, or I don't know what the word is you would use. You know, most of us chose to reduce. I don't know what the right word is for the buffer zone that you no longer use as a buffer zone. For Asia, it really was so quick and overwhelming. And even before China was in the WTO, the growth of the economy to become dominant in terms of buying raw materials, which kept so many of these countries afloat. Of course, to be providing, as they did for us, consumer goods, to absorb investment. I mean, you look at where, investment from Taiwan and Hong Kong and Japan was going. Probably we'd have to, I'm not an economic historian, so we'd have to go back and look at it, but probably quicker and more comprehensively, at least in a per capita or percentage basis than the U.S. And so for them, I don't know if these competitive strategies entered in really at all. And then again, it's a question of scale. The only two countries which even could have had a hope of having a really competitive strategy, and I would include in the idea of a competitive strategy national self-defense as a competitive strategy, would be, of course, Japan and India. If you're Cambodia, there's no chance of a competitive strategy really. And even Philippines, very difficult. And of course, we still see that today. So what did they do? Well, first, they relied on the ASEAN structure, the Association of Southeast Asian Nations organization and structure, in order to try to create a multilateral, multinational primary place of discussion about intra-Asian issues. Now, there's great limitations to what ASEAN has done, but at the same time, anyone who sort of goes against ASEAN in a way is seen as, it's not quite cricket, right? They're not quite playing by the rules that Asia itself has begun to introduce, of saying these things will be discussed through ASEAN initiatives and at ASEAN ASEAN gatherings. And so that sort of was an attempt to, as I think the political scientists would call it, to, ensnare or entrap China within these sets of discussions. Because what Beijing likes to do, and why, again, you said, what lessons have Asian nations learned? Beijing likes very much to do one-on-one bilateral engagements, whether it's over trade or diplomacy or security or whatever it is, because again, the scale means they are so much larger that really no nation has a chance of successfully resisting Chinese pressure. So the ASEAN approach was one where you could multilateralize this. So that was one thing they did, was use international and internet, not an international, but a regional institution. And so European nations might consider, does the EU serve that purpose? And if so, how would we strengthen engagement with China through the EU? A second pattern, of course, that a number of the nations did, and these were the treaty allies of the US, was to rely more heavily on the alliance. Now, those were pre-existing alliances. They were not created because of US-China relations. They were created because of the Cold War. But post-Cold War, they began a pivoting, so to speak, to address the issues of US-China relations, China's growing influence and power in the region. We see that with the question of territorial disputes in the South China Sea, the Senkakus and the Paracels and the like. For Japan, relying for the U.S. on the Senkakus, the Philippines on, whether it's Second Thomas Shoal or the reefs that it has been worried about. So this was a limited tool, but it was one that seemed to provide the most direct potential of security assurance, which was rely on the alliances. A third approach, which was not undertaken directly by the nations of ASEAN themselves, but one in which they participated, was the gradual broadening of other types of multilateral initiatives on the part of the U.S. and other partners. So one would be Quad, one would be AUKUS. Now, those, again, they're primarily limited to the direct participant nations, but they have discussions with other nations in the region, and there certainly are discussions about having discussions. So again, using the larger nations within the region to come up with new potential ways of looking at common interests, defending those interests, engaging with China, is something that I think, again, we're in the early stages of, but something that potentially will expand in Asia. And so then the question is this in any way transferable to Europe. I mean, already you have the UK in AUKUS, you have the UK in CPTPP, you have the French, of course, with all of their territory in Asia and in the Pacific, particularly in the Pacific, working with other nations. Obviously, they tried to work closely with Australia and still working at that, working with India. The French and the Japanese work together. So that again is out in the region, but it is the potential, as for example, a country like Japan has gotten closer to the NATO grouping, for European nations to begin thinking about how the Asian nations, which much more directly and immediately face the question of Chinese policies, whether they're benign or not, can they transfer any of these? And I would say those were at least 3 approaches that were taken.
Thank you so much. Unfortunately, we are growing short on time, and so I have not been able to turn to as many of the prepared questions. I do want to take the last remaining few minutes of our time to try to summarize some of the audience questions, and also give each of you the opportunity to chime in with your prediction for 2024. So clearly there's a lot going on: the war in Ukraine, upcoming elections in the EU, US, Taiwan, elsewhere, growing trade tensions. So I would love for each of you to just give maybe 1 or 2 sentences about how you think these things will shift in 2024. What are the key things our audience should watch for? And then if you do care to chime in on some of the audience questions on investment screening, if you have any advice for policymakers on what they need to get right, do feel free. So very quickly, I will first turn to Magdolna and then to Misha for the last word. Over to you, Magdolna. First on your prediction for 2024, and then any thoughts on investment screening.
Just very, very briefly, and it was, I think Dr. Auslin already mentioned that Europe is not the key player in that respect. So Europe's reactions are quite kind of delayed and weak up till now. So I think it is the US-China relationship which is determining from the point of Europe. So maybe Europe should take a more kind of proactive stance in terms of towards China. There are some signs that there is some more activity going on, but I don't think it will happen next year, maybe later on. And investment screening, fortunately enough, one of my colleagues had a look at the data which are now available on investment screening in Europe, and whether it is efficient or not. That's a very important question. What he found was very interesting, that there are very few investments which are banned, actually. Something like 1% of total which is screened or monitored. But what he found, that about 1/4 of those which go to the monitoring phase are somehow modified. The ownership share of Chinese investors is reduced from 35 to 20% and things like that. So there is rather a kind of modification and not an outright ban on investments which seem to be risky in the European Union. So that's the result for 2021. I think we will see something very similar, not an outright ban, but trying to somehow reduce the risk further. Thank you.
Thank you so much. Misha.
Yeah, I'm sorry, there's so much and by the way, I do want to say the questions are really excellent. Very first thing I would say is, for those who are interested in some of the attempts to better understand the broad scale of where we are competing with China and how we're competing with China, the work, Liza, that you're doing with the team at Special Competitive Studies Project, I would recommend to everyone to take a look at SCSP's work. And that actually, I think, is starting this process of a much more detailed and granular exploration of how and where China is making inroads and how and where we're losing ground. So I highly recommend people going to SCSP's homepage. A lot of, I think very briefly on 2024, for the US, it really depends on during the election, everyone will sound tougher. And then if you see a second Biden administration, I think they will, as they look to a second term, attempt to figure out ways of having a greater stability in the relationship and ways of creating, again, looking at the question of cooperativeness. Every time a new administration comes in, they always come in with a harder perspective in the beginning, and then they often change that. So it just really depends who's elected. But I think it will be. We're not going back, even though there's still a debate. We're really not going back to the old days of unrestrained engagement across the board. And so it's really trying to find a new equilibrium. Some of the really great questions. There is an important issue about the national level versus the state level of Chinese investment. We've seen that play out in land purchases, and we had a question about land purchases. That is something where, in our federal system, the states do have a great deal of latitude. I think we probably need some sort of state federal level engagement, whether it's a commission or a board, or not that you want to have more of those, but nonetheless, we need to discuss these things, try to come up with rules of the road. We do need to try to be smart about limiting investments, not to just limit them across the board. It's where and how and what. What do you limit? We also had a question, by the way, about international institutions. And that's very important too. We need to counter Chinese influence in international institutions, because when Chinese officials take leadership roles in those institutions, they are essentially acting as agents of Beijing. When American officials take leadership roles in those institutions, they act as agents of those institutions, often at contrary purposes to Washington's own policies. The Chinese act differently. So we do need to try to make sure that groups like the WTO and others that we are watching. We know that the Chinese are trying to influence them. The question is, are we willing to impose whatever types of costs to ensure that these institutions remain neutral? So we are again, I would argue, in the beginning stages still of assessment and reassessment, and of trying to figure out what the policies are. But because the Chinese have been so successful in penetrating, not just at the national level, but at the state and local level, at least in the US, I don't know as much about Europe. We have a sort of a three-dimensional chessboard on which we're playing, that we need much more to have very serious conversations, again, about what I would call the new realism, how to protect interests without ensuring that we are overreacting. Thank you.
Thank you both so much. I think that's a great place to end it, with Misha's comment about this new realism that's evolving on both sides of the Atlantic. I also want to thank Magdolna for explaining and enlightening us more on this growing asymmetry between China and the European Union in terms of their economic relations, in particular trade and investment. So thank you to all of you for joining the discussion. Thank you to those who contributed questions through the chat, and I'm sorry we could not get to all of them. This is a really rich topic, and we have two excellent experts, and we could have gone on for a lot longer. If you would like to learn more about Common Sense Society and follow our work and help us build a future that draws on the best of the past as well as the present, please visit commonsensesociety.org, subscribe and follow on social media, or participate in upcoming events. So thank you all for joining us for this timely conversation about timeless principles. And that includes our event for today.